A guarantor loan is the use of an additional property from a third party as a security for the purchase of your home. Generally, a family member such as parents and siblings can be used. This could only be used when the guarantor security has sufficient usable equity from the home. This would benefit anyone who doesn't have sufficient deposit and wants to avoid lender's mortgage insurance. Generally, the banks would like to see 20% deposit plus stamp duty to avoid paying this premium, as anything above 80% is considered a riskier application. For example, the median house price in Sydney is around $1 million. Therefore, to avoid lender's mortgage insurance, you need $200,000 as a deposit plus stamp duty of $40,207. Therefore, you need a total of $240,207 as a deposit. Now, let's say you don't have that much money and you only have $140,207. Therefore, borrowing 90% of the value of the property. In this case, you could be paying up to $26,000 in lender's mortgage insurance, depending on which bank you go to. Therefore, by using a guarantor, you could avoid paying this premium of $26,000, as the equity they have could cover the other 10% shortfall. So how does a guarantor loan work? First, you have to find out how much usable equity the guarantor has. For example, say your guarantor's property is worth $1 million and they have a loan of $450,000 remaining. The banks will allow to lend up to 70% of the value of that property. At 70%, it's $700,000 minus the current loan of $450,000 means there is $250,000 of usable equity to use. Now, let's say you have the cash to use, but you prefer to keep this cash for a rainy day. Therefore, you would like to borrow 100% of the purchase price plus stamp duty for the purchase of a property worth $1 million. To avoid paying LMI, you would need 20% deposit plus stamp duty, which equates to $240,207. Since the guarantors have $250,000 of usable equity, this is more than sufficient equity for them to be a guarantor and for you to borrow 100% of the purchase price plus stamp duty. By them being a guarantor, the bank lending you the money will take an interest over their property until they are removed as a guarantor. So, do they need to be working? Well, depending on which lender. Some banks require them to be still working, while others are okay if they are retired. So how to remove them as a guarantor? To release the guarantor's property as a security, there are 3 ways. Number 1, the borrower needs to pay down the loan to a level where the debt is 80% of the value of the property. Number 2, house prices increase substantially so the loan is 80% of the value of the property. And the last one is a mixture of both, where it's a mixture of the borrower paying down the loan and also the value of the property increases to a level where the loan is 80% of the value of the property. A guarantor has no real benefit in providing the property as a security whatsoever, and it's more used for the benefit of the borrower to get into the market earlier and avoid paying lender's mortgage insurance. It is highly recommended that the guarantor seeks legal and financial advice from a third party to determine how it will affect them. So, what are the real benefits? If you don't have enough deposit, using a guarantor will allow you to avoid lender's mortgage insurance. It allows you to enter the market faster. You can unlock more favorable products in comparison to loans that are mortgage insured. And lastly, you can even consolidate some minor debts, such as credit cards, when you buy a property.